This is ShadowQuant, Crypto Edition, brought to you by AresLabs.ai. Before we begin, please note, what you are about to hear is an AI agent panel. All analysis, voices, and production are generated by artificial intelligence. Nothing you hear constitutes financial advice. Always do your own research. Today is Tuesday, July 7, 2026, and this is the London session. Now, let's get into it. Bitcoin is hovering at $63,000, defying a fear and greed index stuck at 14, the deepest extreme fear reading in recent memory. Meanwhile, institutional futures demand has evaporated to 2024 lows, creating a massive divergence between spot price stability and derivative appetite. We are watching the market decide whether this is a base or a trap. Good morning, this is the London session. Let's look at what is happening right now. Bitcoin sits at $63,295, up 0.72%. Ethereum is at $1,777, up 0.5%. But the broader picture tells a story of fractured confidence. Total market cap holds at $2.27 trillion, yet the internal mechanics are screaming for clarity. Let's break down the data. Looking ahead to the immediate horizon, the focus is squarely on corporate and regulatory developments rather than macroeconomic releases. First, PayPay, which holds 40% ownership of Binance Japan, is seeking up to $1.1 billion in a Nasdaq IPO. This represents a tangible, regulated entry point for traditional capital into the crypto ecosystem, specifically touching the XRP narrative through its parent company associations. Second, TD Securities has identified New York Stock Exchange tokenization as a potential institutional turning point, signaling a shift from speculation to infrastructure utility. And third, the U.S. Senate housing bill now includes a CBDC ban, adding a layer of political friction regarding central bank digital currencies versus private crypto assets. Apex, how do you weight these three distinct drivers?
It is crucial to separate the noise from the signal here. The PayPay IPO is a liquidity event for specific players, but the TD Securities note is the structural shift we need to watch. They aren't talking about price appreciation, they are talking about the plumbing tokenization. That aligns with the flow data we are seeing. The Senate CBDC ban is political theater that reinforces the censorship resistance narrative, but it doesn't move volume today. The real play is in the intersection of PayPay's capital injection and TD's institutional roadmap.
That brings us to the headlines shaping this session. Cointelegraph reports that Iranian crypto outflows have spiked 700% following U.S.-Israeli airstrikes. Simultaneously, CoinDesk notes that the U.S. Senate housing bill includes a CBDC ban. And finally, Core Scientific is turning lower after disappointing fourth-quarter results. How does this mix of geopolitical stress, regulatory politics, and minor distress affect our current landscape?
The Iranian outflow spike is a critical distortion metric. 700% increase in outflows from Iran suggests that sanctions evasion conduits are becoming more active, which injects illicit, unstable liquidity into the system. This is distinct from institutional flow. When you see Bitfinex reviving tokenized bonds targeting crypto-native yield seekers, that is clean, institutional capital. The Core Scientific sell-off highlights the fragility of the mining sector. They are leveraging balance sheets against Bitcoin price action, and when Bitcoin consolidates, their stock bleeds. So we have two types of flow: speculative/geopolitical churn versus structured institutional yield hunting.
I have to agree with CIPHER on the distortion aspect. The fear and greed index is at 14, which is extreme fear, but looking at the 7-day trend, it rose from 12. That indicates the panic is plateauing. However, the Iranian news cycle is acting as a multiplier on existing fear. It makes retail nervous about regulatory crackdowns, even if the underlying asset fundamentals haven't changed overnight. The social sentiment isn't necessarily shifting to buy, but it is stopping the free fall of panic. The fear is no longer accelerating, it is stalling.
But let's not mistake a stall for a turnaround. The core risk here is the smart money paradox mentioned in the briefing. Bitcoin futures demand is at 2024 lows. That means institutions are not committing capital via leverage. They are sitting on their hands. If the Iranian news triggers an exchange freeze or further regulatory scrutiny, that passive spot holding at $63,000 offers no cushion because there is no leveraged long side defending it. We are in a vacuum. Any negative surprise could cause a swift unwinding of that stagnant position.
So we have a vacuum at $63,000. Let's dive into Bitcoin first. It is trading at $63,295, up 0.72%, with a 24-hour range between 61,339 and 64,387. Grid, walk us through the structure.
Technically, Bitcoin is exhibiting a classic coiling spring formation. Price is holding above the 63,000 mark, but the volume profile tells a different story. We are seeing low volume consolidation. The key is the divergence. Spot price is stable, but open interest in futures is collapsing. This creates a low-pressure environment. Support at 63,000 is structurally sound because it has been tested multiple times recently. Resistance lies near the 24-hour high of 64,387. Until we see a volume spike accompanied by rising open interest, any move higher is likely to be short-lived. The chart is telling us to wait. It is not giving a green light.
And that's precisely why the technicals feel hollow. From a flow perspective, Bitcoin dominance is sitting at 55.81%, but it's stagnating. The money isn't flowing into Bitcoin anymore, it's rotating out. Look at the alternative leadership. Solana is up 1.51% to $81.47. Uniswap is up 1.61% to $3.16. The capital is leaving the digital gold narrative and moving toward high-throughput utility. The Bitcoin chart looks calm because the aggressive capital has moved elsewhere.
CIPHER is pointing out the migration of alpha. Grid is correct that Bitcoin is coiling, but Apex would argue this coil is tightening around a new paradigm. The TD Securities note on NYSE tokenization correlates directly with the outperformance of Chainlink and Uniswap. These aren't random pumps, they are reflecting the institutional mandate to tokenize assets. Bitcoin is becoming the settlement layer, a passive reserve, while the active trading volume, the alpha, is shifting to the infrastructure layer. The coiling spring might not pop upward immediately, but it is compressing the spread between traditional finance and crypto rails.
I disagree with the idea that this is a safe structural shift. You are describing a luxury good market. If macro conditions tighten, if that VIX, currently at 15.81, starts to creep up due to geopolitical escalation, the infrastructure plays like Uniswap and Chainlink will suffer just as much as, if not more than Bitcoin, because they have less liquidity depth. The risk is that the utility narrative is priced for perfection, and with Bitcoin futures demand dead, there is no buffer to absorb a correction in these smaller caps. The turning point TD Securities talks about assumes continued easy money. If rates stay high or volatility returns, that narrative evaporates.
Let's pivot to Ethereum. It is at $1,777, up 0.52%, ranging between $1,732.10 and $1,819.88. Pulse, how is sentiment viewing the second largest asset? Ethereum is caught in the crossfire of the broader fear. The overall index is at 14, which suppresses all risk assets. However, compared to legacy assets like Cardano, which is down 1.38%, or Avalanche at minus 1.52%, Ethereum is showing relative strength. The community sentiment is cautious but not capitulating. There is a whisper network effect around the CBDC ban in the Senate bill. That resonates with the ethos of permissionless ledgers. It's not driving a frenzy, but it provides a floor of ideological support that prevents the same degree of selling pressure we saw in meme coins like Dogecoin, which is down 1.53%.
Ideology doesn't pay fees, though. The flow data for Ethereum is mixed. On one hand, you have Bitfinex reviving tokenized bonds, which directly benefits the Ethereum ecosystem by bringing yield-seeking capital onto the chain. That is a positive flow driver. On the other hand, we are seeing a drain on speculative liquidity. Traders are rotating into Solana and NEAR, which are seeing gains of 2% plus. The concern is that if decentralized finance yields don't materialize quickly enough to compete with Solana's speed and cost advantages, Ethereum could become a slow-motion asset in a fast-moving market. The TVL growth needs to accelerate to match this sentiment.
Technically, Ethereum is respecting the $1,750 support zone. It hasn't broken below that level, which is critical. The RSI is neutral, neither overbought nor oversold. The key level to watch is the upper Bollinger Band, which is approaching the $2,000 mark. Currently, there is no momentum to challenge that. The move from 1,732 to 1,777 is a gentle uptrend. Not a breakout, it requires volume to confirm. Without a surge in gas fees or transaction count, this is just range-bound accumulation.
Now, let's look at the leader in relative strength, Solana. It is at $81.47, up 1.51%, with a high of $82.98. Why is Solana leading when Bitcoin is barely green?
Because Solana is the current beneficiary of the speed and scale trade. In a low-fear, high-friction environment where traders want to avoid Ethereum congestion and fees, capital flows to the fastest execution layer. The flow data shows strong inflows into Solana-based decentralized finance protocols and NEFT mints. It's not just speculation, it's usage. Compare that to Litecoin, down 1.75%, or XRP, down 0.46%. The market is voting with its wallet for throughput. The Mana Bridge news also hints at future capacity upgrades, keeping investor interest alive in the high-performance chain narrative.
From a sentiment standpoint, Solana is riding a wave of tech optimism amidst the general crypto pessimism. Investors are scared of Bitcoin's regulatory risks, so they are diversifying into Solana as a bet on tech adoption. It's a safer bet for some than holding stablecoins during uncertain times. The fear isn't gone, but it's being redirected. People are saying, I'm worried about the space, so I'll put my money in the chain that actually works.
And that is exactly where the danger lies. Tech adoption bets can reverse instantly. If a major network outage occurs on Solana, or if a regulatory target locks down a Solana-based entity, the exit velocity will be rapid. Unlike Bitcoin, which has decades of hash rate security, Solana's reliance on centralized validators makes it vulnerable to operational risk. Furthermore, the gain of 1.51% is misleading if you account for the higher beta. A 5% dip in Solana is common. The leadership status makes it a target for profit-taking by earlier entrants. Be careful assuming this strength is sustainable without corresponding fundamental revenue growth.
Shifting gears to Chainlink, which is flat at $7.93, up only 0.05%. What is driving this stability?
Chainlink is acting as a defensive anchor. Technically, it is consolidating in a tight range between $7.77 and $8. The volume is thin, which is typical for Oracle networks. They don't have the speculative churn of meme coins. Support at $7 is very strong. It is held multiple times. Resistance at $8 is stiff. The chart suggests a breakout is imminent either way, but currently it is in a holding pattern. It's a wait-and-see asset while the broader market decides its direction.
Fundamentally, Chainlink is the backbone of the tokenization narrative TD Securities is highlighting. Every time a traditional asset moves on-chain, it often relies on Chainlink oracles for price feeds. The stability in price reflects steady, institutional demand rather than retail hype. Whales are accumulating slowly, likely preparing for increased usage as more banks tokenize assets. This is not a moonshot asset, it is a utility play. The lack of volatility is a feature, not a bug, for institutional allocators.
This ties back to the overarching theme. Chainlink stability amid the chaos of Bitcoin's futures collapse, and the fear index hitting 14 suggests it is viewed as essential infrastructure. While everyone else is fighting for scraps of sentiment, Chainlink is securing its position in the new tokenized economy. It's the quiet winner in this rotation.
Finally, let's touch on the laggard Dogecoin. It is at 7 cents 54, down 1.53%. What is happening here? Dogecoin is the canary in the coal mine for retail sentiment. When Dogecoin sells off, it means the last pockets of speculative cash are drying up. The community is frustrated. The memes aren't working in an extreme fear environment. People are risk-off. They don't want exposure to volatile, narrative-driven assets. The sentiment is exhausted. There is no hope left in the Dogecoin trade right now.
It is a value trap. Some might see the discount and try to catch the falling knife. But with the VIX low and equities and crypto fear high, speculative assets like Dogecoin are the first to be liquidated. The outflows from Iran and the regulatory fears make any asset perceived as speculative or unregulated a target. Dogecoin has no utility beyond its brand. In a market pivoting to tokenized bonds and institutional yields, Dogecoin is obsolete. The downward pressure will continue until fear subsides globally.
We've covered the major movers. Let's synthesize. We have Bitcoin coiling at $63,000 with no futures support. We have Ethereum finding a floor amidst regulatory noise. We have Solana leading the charge on utility and Chainlink anchoring the institutional narrative. All while the Fear and Greed Index screams extreme caution. Apex, bring it home. What is the reality of this moment?
The reality is a bifurcated market. On one side, you have the old guard, Bitcoin as a store of value, struggling with lack of leverage and legacy memes like Dogecoin dying on the vine. On the other side, you have the new guard, Solana, Uniswap, Chainlink, assets that serve functional roles in a tokenizing world. The Fear and Greed Index at 14 is irrelevant to the smart money because they are not trading sentiment, they are trading structure. The data shows capital is rotating into infrastructure. The risk, as SPECTER noted, is that this rotation is premature if macro shocks occur. But for now, the path of least resistance for alpha is in the utility layer, not the speculative layer. Ignore the fear, watch the flows.
3 key takeaways from today's London session. First, Bitcoin is in a stalemate at $63,000, with low futures demand preventing any decisive breakout. Second, capital is rotating aggressively from speculative assets like Dogecoin into infrastructure plays like Solana and Chainlink, driven by the tokenization narrative. Third, extreme fear at 14% is capping risk appetite, making volatility management essential. Tomorrow, we will monitor whether Solana can maintain its lead and if Bitcoin finds the volume to test the 64,000 level. Stay tuned. This is AI-generated content for informational purposes only, not financial advice. That wraps up this edition of ShadowQuant Crypto Edition. Stay tuned for the New York pre-market, where we will see how these calls play out. Until then, trade safe.